a metric ceases being an effective metric once it becomes used, right? Like we can observe the S&P 500 and be like, oh gosh, isn't that interesting? Look at the performance of the S&P 500. But if it's an uninvestable index, it's, purely an output from the system. The minute we turned it into an investable index, we changed the character of the system. This was actually the source of the trade that I did that I'm most famous for, which is the Volmageddon trades around the inverse VIX complex in 2018.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome, everybody, to this episode of the Bull of Wall Street podcast, and I'm psyched today. We've got on a celebrity in the finance world. I've never actually had a chance to actually meet Mike that well. I think I may have shaken his hand a year ago in New York at one of their company meetings. But he has an incredible amount of followers on Twitter and the people that watch what he says. So we're very excited about that. Mike, I'm interested in learning more about you and your background. And Paul Kim is a friend of mine, very close friend of mine. And Paisley, as you know, also helps us with our investment committee. So we have a great relationship with your firm, Simplify. And very excited to have you on and grateful that you're able to join us today. And Talley is our chief market strategist, Talley Leger. He's in New Jersey, and Jim Warden in NorCal is our chief investment officer. So the 3D guys, I'm sure, will be talking about things that I won't understand later. But this podcast is for financial advisors, and and I'm a financial advisor too, Mike, for a long time. And as you know, when you're talking to people like us, we're mostly interested in, is a market going to go up or down? Maybe what sectors we should be buying into or not. But one thing that Paisley did mention, which was interesting to me, is I saw your name on a list of people that my good buddy JOC, John O'Connor, sent me. I'm not sure if we can get into much on the subject matter of what that was. It was around the meeting that you guys had in Hawaii. Mm-hmm. And he said Alan Parker, who's been on our pod with John, JOC was there coordinating some things, but JOC is a good friend of ours, and I'm very interested in geopolitics. So if you can talk about anything that around that subject, we'd love to hear. I think the listeners would love to hear. That being said, if I can just open up the conversation with your background, I think a lot of advisors, retail financial advisors, may not know who you are, but I know that a lot of investors follow you. So go ahead.
Sure. So I've been doing this for about 30 years now, a little bit more than that. It's a little frightening. I actually was laughing the other day because somebody in a feedback on a podcast said, those in the under 50 crowd like Mike Green. And I'm like, yeah, no, that's not true anymore. It hasn't been for a while. But I've been doing this since the early 1990s. Originally came into Wall Street as a corporate finance strategist with a specialty in M&A work, built a software company in the mid-1990s, sold that towards the end of the decade, transitioned into active asset management, initially going into separate account management, then transitioning into mutual funds, then into hedge funds. Founded the New York office for a firm called Canyon Capital Advisors, which is about a $25 billion multi-strat based out in Los Angeles. Was there for 8 years, built that team to about $5 billion and about 15 people, and then launched my own firm, which was, interestingly enough, seeded by our current Treasury Secretary, Scott Bessent, when he was the CIO at Soros. Managed that for a couple of years, then was hired by Peter Thiel to manage his personal capital, did that for a 3-year period. And then soon after that, the changes in the regulatory environment that have facilitated the explosion of different types of ETFs, in particular ETFs that have derivative type strategies embedded in them, which is the work that I've largely been known for over my career. became possible, and we launched Simplify Asset Management in September of 2020. Today, we're about a $7.5 billion firm. And my role is as chief strategist, and then I directly manage our high yield product, which has its own interesting derivative overlay and approaches to it that has contributed to that performing relatively well. So that kind of brings us to where we are today, which is me joining you guys. And I have to confess, I've heard Talley's name before. I had assumed it was pronounced Ledger, and I just thought it was the greatest name for anybody in the history of financial markets to be named Talley Ledger. So I'm disappointed today.
Talley D. Ledger, right? Yeah. It's not a fake name.
Well, Talley's got a Canadian roots, his Canadian roots. Talley, I'm actually headed up to Canada tomorrow.
Okay, so be careful. They're not fans up there.
It's okay. My buddy that I'm staying with has his own little island and a big American flag, and then a smaller Canadian flag next to it.
Oh, so that must be 1,000 islands. We are way off topic, but that's okay.
He's married to a Canadian woman, but look forward to going there, getting out of the heat of the West Coast and the South that I'm in right now. But Mike, thanks for that background. Fascinating. Before two gyms ago, a gentleman that used to work in our investment committee was following you years ago. And so he brought up your name, and he would follow a lot of hedge fund type money managers and so forth. And so I knew about who you were back then. I know, obviously, from a big macro perspective, and maybe Talley, you could jump in with the first question.
Yeah.
We'd love to hear your views about where we're at today, both U.S. and maybe globally from a macro perspective. Talley, you want to add to that?
Well, yeah. So, pleased with the macro, but for maybe selfish reasons, because we're kind of putting the finishing touches on our mid-year outlook. And I had a chance, Mike, to go through your deck and all your thoughts and work on passive versus active, which was great. But it was the valuation component that I wanted to kind of coax out for the benefit of our advisor audience. Maybe you could talk to us about why the rise of passive may mean a P of 25 times is perhaps the new normal, not the exception. And describe all the structural buying power behind this market, and hopefully, fingers crossed, not for a while, but is a market crash really the only way we'll ever see a P of 10 times again?
Yeah. So first of all, thank you for showing the interest in my work. Why don't we just jump right to it? I'll actually share a couple of slides that help people to understand this. So I call this presentation The Greatest Story Ever Sold, and the specific question about what is actually happening with the market and how valuations used to work. This is part of the research that I began doing back in 2016. It played a critical role in a trade that I did when I was at Peter Thiel's firm around the inverse VIX complex. We'll talk about that a little bit, I assume. But before you start talking about how markets change, you first kind of have to acknowledge how they have behaved historically. And so I actually went out and I surveyed managers to ask a really simple question. You're a portfolio manager. You have cash in your portfolio, about 5%, so it's not a barrier in either direction. How do you respond to new money coming in? Effectively, what's your marginal propensity to buy or to sell if money is requested from you, contingent on valuation? And so the chart on the left here is showing your marginal propensity to sell on a redemption and your marginal propensity to buy if people give you new money, contingent on the overall valuation of the market. And I was surprised that nobody else had really done this type of research in the past, but it did create the opportunity to understand some of the phenomenon that we had in markets. And we'll talk a little bit about how this changes when you introduce passive vehicles. And so totally unsurprising, people are in an active manager framework because a higher valuation theoretically lowers my return going forward. I'm more willing to sell and less willing to buy as valuations are really high. If valuations are really low, I'm really willing to buy and less willing to sell. Right now, the that should be totally unsurprising. But what was really surprising in this research was the fact that the intersection of these two lines hit at almost exactly 50-50 at exactly the market's historical valuation average of about 16 times. And if you actually feed this into an agent-based model where you create 10,000 different market participants, you give them each some of the responses from these components, from the surveys, and you then randomly give them cash or take cash away, what you discover is a market that exhibits mean reversion. Because as valuations rise, people become more willing to sell, less willing to buy. As valuations fall, people become more willing to buy, less willing to sell. And the output from this system is mean reversion in valuations. This is why the Shiller PE, which many people grew up with over the last 25 years, worked. It basically described the mechanism of mean reversion. When you introduce passive vehicles, though, you are removing one of the filters. And so a passive vehicle is not at all passive. It's actually a systematic algorithm that simply says, did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. And so your marginal propensity is 100%. Now, what that means is as passive gains share, the market is shifted off of that mean reversion towards that 100% marginal propensity to buy or sell. And so if I feed that exact same framework into a market that has passive share gain over time, instead of mean reversion, I get mean expansion. And unfortunately, this perfectly fits the data sets that we're actually seeing in the markets. We are seeing valuations rise on a continuous basis. And it is a little crazy to think that this could be some form of a new normal. Now, whether that means that we require a market crash or whether something very substantive has to change to cause that to reverse, there's a variety of reasons why we can see people sell stocks. One of them occurred in 2022 when you introduce something like interest rate increases or dramatic interest rate increases, and you then think about a portfolio. Let's just use a 60-40 to make my life really simple. If I'm 60-40 bonds and equities and the Federal Reserve hikes interest rates, that causes bond prices to fall. If I'm systematically reallocating my portfolio, that means I have to sell equities and buy bonds. And so that can create conditions for a sale. It can cause the sort of drawdown in valuation and price that we saw in 2022 without a truly substantive change in the system. But what I'm very worried about is ultimately the feedback loops associated with passive share gain that cause valuation to get so high that we ultimately end up selling for the very simple reason that people are permanently over allocated to equities, and strategies like target date funds, the retirement of the baby boomers, et cetera, ultimately start lowering those allocations in passive frameworks. That unfortunately means that you end up with something that looks like a crash, or at least that's the model, that's the output that I get from my models in almost every simulation. So that is the core of the research that you're referring to.
Awesome.
What if you take out the big Mag 7 stocks though, and then now you've got an index that trades at a much lower multiple, and my additional question to that would be, if you could go back in time, or if the people that created the indexes could go back in time, you think a smarter index would be not market weighted?
So the issue ultimately just boils down to anytime you introduce a systematic strategy that does the same thing over and over and over again, right, it is going to be subject to distortions. Market cap weighting is actually not how the indices are currently constructed. They are float adjusted market cap weighting. That smarter index is quote unquote already here. One of the really interesting things to realize is that much of the 1990s .com cycle was actually driven by an improperly constructed index. The indices at the time were built strictly on market cap weighting. What that meant in the late 1990s was that when you had companies that had low floats, that were relatively recent IPOs, or were technology companies with significant insider ownership, that the indices were actually trying to buy more shares than were actually publicly available because they were trying to market cap weight index. as compared to float adjust. And so that meant that they were buying twice as many shares of Microsoft as were actually available. When you try to buy twice as much of something as actually exists, its price will go up more rapidly than other prices. And so this contributed to the dot-com cycle in a fairly meaningful way. We didn't have the tools to understand it or analyze it at the time. And it took actually a very similar event in the Chinese stock market in 2015 for me to fully understand how this had actually impacted things. But the quick answer is that we had a less smart index. Now we have a slightly more smart index. But at the end of the day, anytime you introduce systematic algorithmic strategies, it becomes a version of what the wise do at the beginning, the fool does at the end. And so just mechanically buying stocks by virtue of you being employed and buying them in proportion to their market capitalization has predictable effects on market behavior that I think many of us now try to, describe as the Costanza market. It just feels like you should do the opposite of what you think, right? And that actually makes perfect sense in this context, because what's happening is we are firing the active managers who buy on the basis of valuation or skew on the basis of valuation and are attracted more to something that goes down in price, right? Because theoretically, if the fundamentals haven't changed, that's supposed to raise your future returns. They reject the company that has gone up in price because with no change in fundamentals, that lowers the future returns, but they're no longer driving the bus, right? The bus is being driven by passive strategies. And if I share one more slide from that presentation, I just want to emphasize that like part of what is actually happening here is that we now have structural outflows from passive vehicles. And I'll share this in 1 second here. And really, since 2016, we have had structural outflows in active manager strategies. That's the red line here, and continued inflows into passive strategies. Paradoxically, that means that the active manager signal, which is again kind of that value and size framework, I'm going to be more drawn to small companies where I can have unique insights relative to everybody else on Wall Street. I'm going to be more drawn to companies that are quote unquote undervalued and therefore lower in price relative to where their prices were before. Those are getting sold. And on the flip side of that, we are adding more money into the Mag 7s. Now, to address the question of valuation, though, it is really important to understand that all stocks are actually being inflated by this process. So the chart on the right here is looking at a cap weighted component. I apologize, it didn't show up in the legend here. I need to fix that. But orange is the cap weighted. So this is fully capturing the Mag 7 phenomenon. But notice that even if I use a median number, that also is rising and rising significantly. It's roughly twice what it was 25 years ago in terms of the underlying valuation framework.
Can I ask a follow-up question to that? Because what you just showed us and Jimmy's question, I want to dig into market concentration versus diversification a little bit, because I think it's fascinating. Why would a purely passive indexed market be such a disaster? You had the John Bogle quote up there on your screen. Talk to us about all the risks, and I know there's a bunch, but include maybe the fallacy of diversification when correlation coefficients go to 1, market concentration, et cetera.
Well, those are all certainly components to it, right? So remember that, if I continually add more of the next incremental dollar to the stuff that has gone up in price and market capitalization, that creates a positive feedback loop where those then rise even further and we drive market concentration, which has largely been a feature of the market that we have seen over the past 25 years. There have been periods, by the way, of brief interruption that have been tied to different style of investing, right? So the late 1990s, as I indicated, I often refer to as passive 1.0. We were drawn to low float stocks. They outperform, because of the index construction and their outperformance. That in turn caused people to buy into the narrative. I want to own the same things that insiders own, right? Or I want to own new technology IPOs because the management teams are still there. and they're more entrepreneurial and they're superior. Those are all, I think the technical term is bullshit. The simple reality is that we were performance chasing, and we're doing it again with the concentration framework. Where it takes on a really, somewhat unique and perverse framework is actually in the way that we measure performance. And so again, I'm going to keep jumping back to my presentation because one, I spent a lot of time on it, and two, hold on one sec here. I just screwed up.
It's helpful.
Yeah, and two, it's helpful to be able to show pictures, right? My wife hates charts, but most people seem to like them.
We're chart guys. Don't worry about
it. When you see this rising valuation, remember that historical returns are positively affected by rising valuations. That shows up as a higher and higher return. This actually creates a really perverse framework. So if you think about how we measure performance in the industry, we talk about modern portfolio theory and the idea that asset returns are somewhat normally distributed around an expected return. As financial advisors, I'm sure you've sat down with your clients and said something along the lines of, well, the average annual return to the S&P 500 on a total return basis is around 10%. And so we're going to be conservative. We're going to assume 8% in constructing your portfolio, and we're going to do X, Y, Z, right? We're going to build a portfolio around that. That's all predicated on this idea that there's a central tendency to returns, and then there's cyclical variation around them. But if I use that 8 to 10%, that feels pretty good. But if I'm in a regime in which valuation is being driven higher by the style of investing, and by the way, perversely, it can actually be driven lower. You may remember in the aftermath of 2000 that hedge funds became very popular. Hedge funds, by and large, were running long-short portfolios. Perversely, that meant that they were actually increasing the supply of securities relative to when you were running long only. So hedge funds actually, the growth of hedge funds largely didn't create a huge net demand for securities. In many ways, they were actually supplying more securities. And so valuations were able to fall during that time period. Once hedge funds began to lose out to, effectively long only again, we saw this trend reassert itself, and it really took off in style. But here's where it gets really perverse, because when time becomes a proxy for passive management, so we see this valuation rise over time, instead of that flat line with the cyclical variation, we now have a structural upward shift. And if you think about what alpha actually is, right? Alpha is just the idiosyncratic intercept in a linear equation where we are saying y equals mx plus b. Take yourself back to 6th grade here for a second, or maybe 8th grade. Yeah. And recognize that what we're saying is the return on your portfolio is the beta of the portfolio times the market return plus some idiosyncratic alpha framework. This is a linear equation. If I try to use a linear equation to solve a surface that has become curved, mechanically, what happens is my intercepts are forced lower, right? Now, if we talk about alpha as the measurement of skill for active managers, and we enter into a market regime where our type of investing, the growing dominance of passive, actually creates this convex surface, we are setting up conditions under which we decide that active managers are getting worse and worse and worse. So here's the theoretical framework for what this should look like. And here's the actual data, right? And so what we've actually done is we have created an active manager killing machine that we then turn around and characterize it as, hey, this is a great thing because it's causing active managers to lower their fees in order to compete. The simple reality is that we are losing vitality and functionality within the markets. They are increasingly losing their ability to provide marginal pricing of capital. And they're doing it in ways that are, one, perversely driving more and more business activity into large public companies, and simultaneously making it very hard for new companies to go public because new companies are not in indices, right? And so you end up creating a bifurcated economy that many people have called the K-shaped economy, right? It's not only true for households where wealthy households are doing well and those at the lower end of the spectrum are doing worse and worse and feeling increasingly disassociated. It's also happening in businesses where the large publicly traded companies, and perversely the largest publicly traded companies, have a lower and lower cost of capital and financing, even as we should be looking at them and saying, hey, wait a second, we're giving money to these people, and all they're doing is buying back their own shares or paying their employees outrageous sums through stock option grants. That doesn't sound like a good use of our capital, but gosh, it's working, right? And so we've stopped the thoughtful application of it that is creating conditions that drive the bifurcation of our economy. And candidly, I think in many ways driving a sense of hopelessness, because most people recognize they can't compete with these giant multinationals, nor do they feel adequately represented in negotiations with them on a political framework, right? So they increasingly get the sense that those who have access to the halls of power have differentiated benefits, the socialism for thee and not for me sort of framework. And it also candidly is destroying the diversification benefits of investing in things like the S&P or even a total market index, which is now 97% large cap US equities. Small caps no longer really exist as meaningful representation.
Could I ask a follow-up question on, because Jimmy asked a question about going back in time. If you were going to go back in time, and maybe you take Eugene Fama with, and I don't know, Rob Arnott, whoever you want to go back and meet with John Bogle, and if you're going to recreate indexing, if this was done with a multi-factor approach that included mean reversion or included value and included low volatility, some of these other factors, because, a lot of this is driven by momentum, right? If you could do that and make that systematic, would that still be just as problematic today? Or would it be less problematic? Or I'm just trying to understand kind of like, if I know we can't do this, but in theory, if that's where the money was, wouldn't that have kind of an auto-correcting mechanism that didn't put too much in momentum?
Well, there are ways that we certainly could have changed it, right? But anytime you create a systematic algorithmic strategy, the real risk is that you effectively bless it. And you say, this is the right way to invest. And so passive investing or index-based investing has largely been declared as safe and appropriate for the masses. This really took form through a series of government regulatory changes. I highlighted one that brought me into the ETF space. Similar changes have occurred in the past that have effectively driven the American retirement system into our public markets, whether those are fixed income or equity components, is somewhat irrelevant, and designated passive investing as the safe approach. The most important changes that occurred in 1994, even as passive investing was very tiny at that point, it was only about 1% to 2% of the market on the retail side, about 4% to 5% on the institutional side. We actually changed the rules for them in a very substantive way. In 1994, we gave special dispensation that allowed index providers to use S&P futures and then ultimately Russell futures and others for replication purposes. This was one of the first times we really bent the rules for them, basically saying, well, that's a safe space. That's a safe strategy. That's something that we should encourage and not discourage. At that early stage, Vanguard was beginning to experience tracking error. They'd try to buy all the shares, and their buying activity would actually cause many of the smaller stocks to deviate, and that would introduce tracking error in their portfolios. They went to the street and they said, hey, what can we do about it? The street said, well, why are you trying to buy every stock? Just buy futures, right? And when they bought futures, that actually turned it from a Vanguard problem into a street profit opportunity called index arbitrage. And that has largely been driving a lot of the behavior ever since. There was a second regulatory change that occurred under the Bush administration. In 2006, they introduced the Pension Protection Act. This was the entire idea is we're going to shore up the retirement system of the United States in the aftermath of the dot-com collapse. We're going to create additional incentives for people to save. But what we did in that process was we shifted our 401k system from an opt-in framework where you would get a job and you'd have to decide that you wanted to save for retirement to an opt-out framework in which you would get a job and you'd have to decide not to save for retirement. This is the whole nudge framework of Cass Sunstein and Richard Thaler and others in the behavioral finance space. The problem is the minute you actually decide that you're going to opt people automatically into something, you have to decide what you're going to opt them into.
Sure.
And so that was where what's called the qualified default investment alternative, QDIA for short, was created. This is a liability protected investment for corporations to offer to their employees. The initial implementation of this was a balanced fund, something like a PIMCO offer of a 60-40 bond equity portfolio or a 50-50 mix. And then in 2012, we changed those rules under lobbying from Vanguard to make it target date funds. And today, about 95 cents of every incremental retirement dollar in the United States now flows into something like a target date fund that just mechanically puts people into the exact same allocations, grouping them on the basis of their age. Right? Anytime you decide that you're going to do that, that you're going to bless something as a particular investment, you're going to change economic history. And the government has assigned liability protection to investing in index funds. Unsurprisingly, liability protected investments are really attractive to sponsors like corporations and 401k plans because they don't want to get sued. Right? I used to joke that Einstein was wrong. The most powerful force in the universe is not compound interest, it's liability avoidance. And that, unfortunately, I think is very true. Like, a corporation is very happy to help their employees as long as they're not creating liability for themselves in the process.
Wow.
That's fascinating. So really longer term, you think about the demographics and where people sit in age, that could dramatically affect how much flow goes into equities or fixed income, et cetera, which, as an advisor, we think it's almost like the worst thing you could do. I mean, the asset mix should be more related to what the client's objectives and return goals need to be, not how old they are, right? It's just a liability protection mechanism, as you said, for all of us in this industry, and can put somebody that has a 30-year plus retirement into the worst asset allocation that'll, make them go broke really slowly. Anyway, that's fascinating to think about that from that longer term perspective and all the regulatory issues that have resulted.
Yeah, that's the core of the concerns that I have is that we simultaneously, and I love this, right? The libertarian crowd will say, well, nobody should tell anyone how to invest. How dare you, complain about passive investing? And my reaction to that is, what are you talking about? You're already being told what to invest in, right? The government has put its thumb on the scale. Yeah. And to not recognize that is, in my opinion, the primary failing of most people that have embraced this type of investment or this type of outcome, is they simply assume that there is no link between the government designating this as the safe and appropriate investment and the subsequent performance that has emerged from it.
Can I ask a question about, maybe it's a little bit related, and I did see something about this in your deck, target date funds. So we actually had a chance to speak to Nick Murray at our conference back in April, which seems so long ago. But I wanted to pick your brain because he thinks that product category is nefarious, because his argument is basically it robs you over time slowly of the one thing, the component that gives you a fighting chance of beating inflation. And that's equity. It's a kind of declining share and an increasing bond allocation towards your target date. What do you think about that? Do you agree?
Well, I don't think any asset is, particularly blessed as it relates to inflation. Equities have a positive inflation component to them in that their earnings can theoretically rise in nominal terms, but the actual ratio of a PE ratio should fall in inflationary time periods, right? We've seen the exact opposite. We've seen valuations rise to near the highest in history, even as interest rates have risen and as inflation has risen, right? We saw both of those basically play through in a way that didn't seem to have any impact on the stock market, and totally different outcome to what we saw in the 1970s. And this is one of the things, unfortunately, that I predicted in advance. I told people that once the interest rate hikes were done, that we were going to go right back to what we were doing before. Because there is no mechanism for saying, gosh, I really think value stocks should outperform in a high interest rate environment, because they have much more of their cash flows near the front as compared to far off in space, right? Off in time and space. Like that was the argument that most value managers were putting forward. Once we get back to real interest rates, then value will outperform. Well, nothing could be further from the truth. That's because it had nothing to do with it, right? The only way that it impacts it is through this portfolio rebalance channel, which is what I was referring to, where, you know, bond prices fall because you hike interest rates. Therefore, I have to reduce equities in my portfolio and add back to my bond exposure. That then hits kind of the second component of it, which is this idea that, you know, is a target date fund robbing you of your ability to invest in an inflation protected asset? I'm much more sanguine about that for the very simple reason that if I look at real interest rates as proxied by tips, so stripping out the inflation component, like we're near the highest levels in history for those real returns. And candidly, we are, somewhat in a somewhat mystifying way there, right? In an environment in which the labor force is growing very, very slowly, and we have more and more people headed for retirement, your base case expectation should be for very low economic growth, because at the end of the day, an economy is just a combination of how many people and how productive each of those individuals are. As your population ages, those people become marginally less productive in the next year, right? We all remember this when we were 22 and we got our first job. A year later, we looked back with amazement at the learning curve that we'd gone through. We're like, gosh, I was so much more productive today. Boss, you should pay me at least 20% more because I'm just so much better than I was a year ago. Nowhere in that is the self-appraisal that a year ago you were worth negative amounts of money and they still paid you. But the simple reality is that you have a very steep learning curve earlier in your career that contributes to rapid productivity gains. As you get older, you just don't get that much better at your job. And candidly, I would argue I'm probably worse at my job than I was 10, 15 years ago for the very simple reason that I need a little bit more sleep and I don't sleep quite as well as I used to. And I'm a little more set in my ways and, spend more time worrying about my kids in some ways than I do about my own life and career. And so all of those things contribute to that and just the simple fact that I can't possibly learn at the same pace that I was as a percentage of what I've already learned, right? And so you end up in a situation where there is a slowdown in productivity growth as you age. And as the population grows more slowly, as that labor force grows more slowly, you end up with slowing economic growth, which should translate to lower interest rates over time and candidly lower inflation. Right. All of the evidence is very straightforward that a slowing population growth, a negative population growth is disinflationary in its construction for the very simple reason that, you wake up tomorrow and your neighbor's dead and his house is now available for somebody else to buy without building a new house. Right. That ratio of labor to capital actually grows, or capital to labor, which is really the productivity component, grows much more rapidly in a slow labor force growth environment than a rapid labor force growth environment. You have less pressure to need to put new capital to work, and you need to put new tools for productivity in place. So I actually think the premise is wrong, to go back to the core of the question, but I understand the point and would more say it's a function of, it's that same framework. If everybody is doing the exact same thing, do you really want to be doing the exact same thing? Right? From a purely evolutionary standpoint, this is Nassim Taleb's fragility versus robustness framework. If everybody does the exact same thing, we're all going to get very similar outcomes, but those outcomes are going to be potentially much more catastrophic. Right? If everybody in a population set decides to veer left when they approach the cliffs of despair, as compared to half going left and half going right, well, the entire population could go extinct immediately. Right? Part of the, look at a zebra hunt by lions, right? Why do they all huddle together? Well, the stripes are really confusing if you're trying to identify a zebra to bite into when they're all herding together. But you know what happens? Some of them veer off. Why? Because sometimes that's the right move and sometimes it's the wrong move. And effectively, they're a sacrificial lamb to draw people away or find an alternate approach. It's a biologically robust response. What we're engaged in now, where 95% are all doing the same thing, man, we're lemmings off a cliff.
Fascinating.
So,
So everyone,
go ahead.
Mike's got a book coming out. I think he said September.
Well, that's what we're targeting. I will be honest with you. Part of the reason you see the exhaustion in my face is the additional effort required to meet that deadline is starting to wear at me. But
Well, I was going to give you some grace and say it could be before Christmas. So sometime between September and maybe like first quarter.
I've got publishers that are putting much more pressure on me than you are, Jimmy. So I appreciate that.
So we know, I think based on what you said, a lot of it's going to be about passive versus active. But are you talking about any of this stuff that you're talking about now? I find this fascinating.
Well, I
just talked about.
Yeah, I think they're all linked. Right. And so this is part of what I find so fascinating that's going on is in general, there's a sense of nihilism that exists in our society right now. That is, for those of us that lived through the dot-com cycle, at least you could look back on that and say, hey, it's stupidly optimistic. Right. This time around, it's basically nihilism that's driving it. Right. So then we would say the internet is going to grow beyond any belief. Right. We're all going to be much richer and much more successful than we thought we ever could be. That was kind of the mantra in the late 1990s. In today's world, it's very much, you know what, if I don't get rich fast, there's not going to ever be opportunity again. The dollar is toast. The US is collapsing in on itself. Right, we are incapable of fiscal discipline or monetary discipline. We're just going to print money until it's worthless, and therefore I should buy equities. Like it's such a weird conclusion to come to if that's actually your underlying belief. Like, you know, people who are out buying gold and canned food and guns probably have a slight advantage over those who are signing up to, you know, stand in line at DTCC and claim ownership rights to their Apple shares. I don't understand what people think that they're seeing, other than the fact that by and large they're trying to explain why the market goes up, not understanding the mechanical aspects of it that I've spent time emphasizing.
So could I ask you, you mentioned fragility a while ago, and it seems like you're kind of saying or alluding that, you know, the market's just gotten more and more fragile. The more people are going in there, 401k plans. So is the solution to insert some anti-fragility, some, non-correlated or negative correlating assets, or assets that have asymmetric, outcomes where, you're not paying a whole lot, but the payoff is huge if you're right? Is that kind of the fix? Is that the solution? Where do we go from here?
Well, the most egregious thing that we have done is select what people should invest in or provide them with a liability protection, right? So I have no objection to tax advantage savings. I have no objection to employers contributing to your savings. By the way, that's simply called a defined benefit plan, right? That's what they used to do. They were responsible for the outcomes. Now they're just responsible for a portion of the contribution. So I think all these things are actually great. Where I think it really becomes problematic is when you mistake an output, right, which is a market index that reflects prices when people were not buying that index, and presume that somehow or another preserves itself once you direct people to invest in it, right? This is a variant of Goodhart's law. A metric ceases being an effective metric once it becomes used, right? Like, we can observe the S&P 500. We're like, oh gosh, isn't that interesting? Look at the performance of the S&P 500. But if it's an uninvestable index, it's purely an output from the system. The minute we turned it into an investable index, we changed the character of the system. This was actually the source of the trade that I did that I'm most famous for, which is the Volmageddon trades around the inverse VIX complex in 2018.
And prior to that, there was the vol collapsing in 2017, right? I mean, you had kind of both sides.
Yeah, I think that they were very closely linked. And again, what was somewhat unique that I was fortunate was in figuring out what was actually going on. And so let me pull this up here.
Power shares, right? We're talking that got swallowed up by Invesco.
Velocity shares is what
Velocity shares, XIV.
Yeah, they're back. But in in May of 2017, I gave a presentation at the Equity Derivatives Conference in Las Vegas, where I highlighted the opportunity to be short via options products like XIV or SVXY, which were the inverse VIX complex. It's really hard for people to orient themselves, to what these products represented at the time. But you can see here's 2016. Here's, give or take, February or January 28th was the absolute peak in the XIV product, in which it rose, over the course of 2 years, somewhere in the neighborhood of 1,100%, right? So basically, Bitcoin type returns. There were articles in the Wall Street Journal about, former target managers launching funds to invest in this thing, et cetera. And I was relatively fortunate in figuring out that what was actually happening was that the inflows into this product were actually creating a feedback loop that was suppressing volatility. The behaviors in the market were actually creating the equivalent of a coiled spring. And then simultaneously recognizing that there were products out there in the form of long-term put options that would allow me to express the trade simply in a premium risk. So the most I could lose was how much I spent on the premium, that allowed me to wait for the trade. We basically identified that what was happening, you can see as the price goes up, most people presume that as prices are going up, something is getting safer. Its probability of going to zero gets lower and lower and lower. But because this was an inverse product, meaning that it did the opposite of what its underlying benchmark was doing, as this was getting higher in price, the VIX was getting lower and lower in price. And the lower the VIX got in price, the easier it became for it to mechanically double. Now, if something is minus 100% of the index, and that index doubles, it doesn't matter how high it is in price, it instantly goes to zero. And so we figured out that the options were just radically mispriced in this, that instead of a normal distribution, which is again going back to kind of the thought process here, that this was a bimodal distribution. The higher it got in price, the higher the probability of it going to zero in a single day event. We came to the conclusion that there was roughly a 95% probability that it was going to decline to zero over the course of 2 years. The options were pricing that at less than 1% probability at the time. And so we were able to make a highly levered, very successful bet on this. Unfortunately, this is the same model that looks like the S&P, right? As it goes higher and higher in price, more and more people are convinced that it is a safe investment. But that also is then making larger and larger the sums of capital that would have to be sold once retirees start withdrawing funds, or once an exogenous event that causes people to sell emerges. And so it actually perversely gets easier and easier and easier for significant drawdowns to occur. I'd point to I'd call them the tariff tantrums or Liberation Day. We saw how easy it was to get a 20% drawdown in the S&P 500 in very, very short order, and then how easy it was for it to bounce back just as sharply. This speaks more to an emergent property that happens when passive gets larger and larger. Stocks become increasingly inelastic in their response. In other words, their price changes a lot for very small changes in supply and demand. And that is, unfortunately, again, a prediction or an expectation that you would have from a market that has more and more systematic strategies that simply operate off of the world's simplest algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. Nowhere in there is there valuation analysis. Nowhere in there is a quality analysis. Nowhere in there is it appropriate for me to be taking these investments at this particular time and this particular juncture in the economy? The only thing that is determining those flows is whether I'm employed and what my age is.
Wow. We're coming up close to top of the hour. Not that we're on some sort of a deadline here, but there are two things for sure that I think financial advisors would want to hear from Mike. And one is the debt situation here in the U.S., your view on that, and can we continue to print money and not go bankrupt, or what the consequences could be near and longer term? And then I'd love to hear your view on Bitcoin and maybe crypto in
Oh
general.
boy. Yeah.
So.
Okay. So on debt, first, recognize that it is very, very hard, if not impossible, for a country to go bankrupt in its own currency. Right. At the end of the day, if I was printing Mike bucks and you accepted Mike bucks, the issue is not that I owe too many Mike bucks, for the very simple reason that I can just print more of them. Right. The issue is, will you accept Mike bucks for activity? And so there is a risk that the dollar falls in value if we oversupply dollars to the world. Paradoxically, debt is actually the tool that's used for managing that flow of dollars. When you sell debt, what you're actually doing is sucking up the dollars that are already in existence and turning them into an asset that effectively will not return those dollars for an extended period of time. If I do that in a 3-month treasury bill, the principal comes back in 3 months. If I do it in a 30-year bond, it doesn't come back for 30 years. So yes, I will ultimately print more dollars associated with that 30-year bond, but it's so far off into the future that I've effectively sucked up that liquidity for an extended period of time, right? So the way in which I issue debt matters a lot. My prospect of going bankrupt is very low. If I do a bad job, the prospect of people ultimately turning around and saying, I don't want to have anything to do with Mike Bucks, that guy's a schmuck, one, is very high because it's true. But two, the simple reality is that the fears around default or anything else are just misplaced. That's not where the issue should be. It should be on the currency. The second thing is, it really, and this is one of the things that's missing in the dialogue, it really matters how you spend it, right? If I issue a whole bunch of debt and I raise dollars, or I decide that I'm going to spend the revenue that I generate from taxes on hip replacements for 95-year-olds, that doesn't do an awful lot to generate future wealth, other than make people feel relatively confident that the government's going to give them hip replacements when they're 95 years old. Right? If on the flip side of it, I use it to build roads and bridges and to educate the young generation so that they become more productive going forward, then I'm actually creating the potential to raise productivity, raise incomes, raise living standards, create additional surplus that can then in turn be invested in bonds or equities or anything else, right? And so I'm much less concerned about the debt than about how we're spending it, which is by and large giving more money to people who already have money and taking money away from people who we have decided are largely undeserving from it because they just haven't shown the capacity to earn a whole bunch of money. Now, in the case of 65-year-olds or 55-year-olds, that assessment could be a pretty good one, right? If you haven't made money by the time you're 55, you're probably not going to suddenly be struck by entrepreneurial genius that says, gosh, I should have been doing this all along. Here's my path to wealth. But for a 5-year-old, that incremental spending can translate to better nutrition. It can translate to better instruction. It can translate to better living conditions that free them and give them the capacity to become more productive members of society going forward. And so my complaint is not so much about the debt or the level of the debt. It's about how we spend the money.
All right. How about Bitcoin? You want to talk about that?
Yeah, only because I like having people yell at me. Look, Bitcoin itself is something that I discovered all the way back in 2009 and I evaluated in a pretty serious way. I bought Bitcoin the first time well below $20 a coin, and then ultimately ran kind of the simulations on it. And part of the reason why I was interested in it was this question of, well, what does a world look like in terms of monetary policy when population growth is slowing very rapidly? And so there is actually an interesting analysis of what happened with the gold standard. We've basically been on a gold standard for an extended period of time. Gold is not Bitcoin. I just want to be very clear on that. But it also doesn't have any form of unique value to it that makes it money, other than the fact that it was designated as such by sovereign entities like governments, right? They said taxes are payable in gold, or more specifically in gold coinage. Right? Gold simply fits on the periodic table next to a bunch of other metals, copper, tin, nickel, silver, that have all been used in coinage. There's nothing unique there. It's just the metallic element aspects of it It's also next to mercury. Mercury doesn't work all that well because it poisons you and burns a hole in your pocket when you put it in there, right? So like every single one of those has been used in coinage, and therefore we think of as money in one form or another. There's nothing unique about gold. It just happened to be relatively rare, malleable, so that it could be turned into coinage. But when you go into the late 19th century, we encountered a radical change in technology. We introduced the germ theory of disease, and suddenly people began living much longer, surviving childbirth, and infant mortality basically collapsed as we figured out, okay, these are the simple steps we can do to avoid people getting killed in an unexpected fashion. That caused global population to explode in a manner it never had before and set off a deflationary period in history that was largely characterized by the quantity of people growing far more rapidly than the quantity of money in the form of gold. And so gold per capita fell in a largely precipitous fashion from about 1870 until about 1905, when we began to actually change the technology around how we extracted gold. We introduced the cyanide process, which allowed us to radically increase the quantity of gold that was produced from tailings and ore. And so we began to increase the supply of gold in one form or another. The population continued to grow very rapidly. And so we largely had a deflationary period from roughly 1870 all the way until about 1940. Right? We then changed the system. We converted to a somewhat fiat-based system. We then completely converted to a fiat-based system in the 1970s, which paradoxically was just about the time global population growth was starting to slow. And so a lot of the phenomenon that we take for granted today, this idea that gold is rising in price, all of that was set free in the 1970s when we had an inflationary output that was simply a function of more mouths to feed, more people needing more stuff, and an inability to produce it in rapid order. We took all the wrong lessons from that. Right. And so, today we have a system in which every time something goes wrong in the credit system, which is basically the private sector's way of allocating money, anytime it goes wrong, the government steps in and bails it out and prints money. This creates the perception that governments are out of control with their spending, that the bailouts are perpetual, et cetera. I don't think that's entirely true, but I think that there's a very valid point to it. And that was the original impetus behind Bitcoin. Right? If you go and you read the Genesis block, it talks about the bailing out of the banks, et cetera. Now, the problem with Bitcoin actually boils down to it's too hard. Because the unique feature of gold was that it does have its own supply-demand curve. And the way we actually did the fiat system under the gold standard was if you brought gold to the government, it would mint it for free into coinage, and you could then use that as money. The gold itself was not money. The minted gold was money. Right? If the price of gold went up, what we call deflation in that time period, there was an incentive to reallocate society's resources to making more gold, either through technology or increased mining activity or increased labor utilization in mining, et cetera. It was a way of lowering the price of gold and hence raising the price of everything else. And it rewarded human ingenuity by basically saying, we will outsource this to the private sector and we'll create the price signal associated with it. Now, Bitcoin, in its quest to be even better than gold, made a fatal error, which is it created a fixed issuance schedule and a permanent cap on the quantity of Bitcoin. The very thing that people think draws them to Bitcoin is ultimately its failure, because there's nothing I can do to increase the quantity of Bitcoin that is mined. So if the price of money goes up, meaning a deflationary outcome for everything else, I have no mechanism to correct that other than speculating in Bitcoin. Right? And so Bitcoin paradoxically is actually short human ingenuity. It's saying there is no solution to allow you to get the price of this to come down until other people decide that it is worth less. Right? And that worth less is literally what it ultimately becomes. It becomes like children's artwork. It's valuable to you, but it's not valuable to anyone else, even though it is very, very scarce. And so my view on Bitcoin is very straightforward, that it is a fundamentally flawed system that is actually designed to encourage speculation, and it's doing exactly what it's supposed to do.
Jim Talley, Any last questions for Mike? I've got one around AI. That's it. I know he's got to go.
So I've got one last question for you, Mike. The role of speculators with the rise of passive investments and high frequency trading, is this making things worse, more fragility because that the passive people aren't trading, so you got a smaller group of traders determining kind of their direction? Or do you think that's a good counterbalance, that it actually kind of inserts what should be more normal market behavior? What do you think?
Well, so the quick answer is that I've got a slide for that. So let's actually jump back to the slide. And this is really kind of the key takeaway on this, which is, if I go back to the mid 1990s, active management was about 80% of the trading activity. Today, that's down around 10%. And most of the trading that you actually see is in things like passive and index derivatives, passive direct trading, and passive market making, which is actually the largest single category. What the market is largely trying to do at this point is facilitate the passive trading. And so it doesn't actually care what's happening to the fundamentals of any individual stock. It's not trying to set that marginal cost of capital or allocate capital in a way that drives forward performance. It's simply trying to solve the here and now of, how do I price the S&P 500 or the Vanguard Total Market Index? And so, Upton Sinclair has the great quote, which is, it's impossible to make a man believe something, other if his job depends on him believing it. By changing this composition of trading, again, what we've done is we've stripped the market of what its purpose actually is. The purpose of a market in any situation is price discovery, whether that's rugs in a Moroccan souk or secondary shares trading on the New York Stock Exchange. And the reason why we care is because that sets the marginal cost of capital for companies, right? 2003, Michael Jensen, who unfortunately has passed away, he's the creator of the SSRN database, which, if you are a financial geek like I am, you spend way too much time on. But it's a social science research network. He wrote a paper in 2003 called the agent-based cost of overvalued equities. And the reason why it matters, like, it feels great. Microsoft is overvalued. Isn't that wonderful? We're all rich. The problem is that sends a message to Microsoft that spending money is basically free. And so they can overpay their employees. They can make acquisitions that are actually counterproductive from a competitive standpoint to protect their existing monopoly. All the sorts of stuff that we're seeing is largely a byproduct of that paper, which was written as a result of the dot-com cycle. It said, hey, look, maybe it's really not a great idea for startups that are unprofitable to spend $1 million on Super Bowl ads. Well, now $1 million is simply the price of entry to your local high school football game, right? So, the money that is being spent by many of these organizations is absolutely unfathomable. You have companies like Meta buying up Instagram or buying up competitors simply to protect their monopoly. And that means that the rest of us suffer from a lack of competition, too high prices for the products that we receive, too abusive of a end user license agreement that would be gotten rid of in a system of genuine competition, et cetera. So the quick answer is that I actually think, unfortunately, this is making it worse, but that's what people's jobs are, right? Market makers are going to market make. And if I give them an incentive to do something, they're going to do it. And that's what we largely are seeing.
Thank you.
So if you would indulge us with one final question, but it's a big one. It's around AI. Just where do you think we're at with it and the impact that it's going to have now and into the short-term future for the economy and investing?
So the way I think about AI, first, I think it is a genuine technological innovation. In the same way that steam power enabled human muscles to do things that they never could have done before, AI theoretically liberates people to do things intellectually that could never have been accomplished before. And so it is going to reorder and change our society. What I think is actually happening is something I call the productization of services. And if you think about, like what a call center is, or going into a bank teller, that is a service that requires human interaction. As I introduce things like AI into that process, I remove the human complexity from it and the extended lead time associated with training a human being, and turn it into an easily replicable product as compared to a service. We've been through this before, right? If I actually think about what a cabbie used to be, it was somebody who drove a horse. Well, what was that cabbie actually doing? Well, they were shoeing the horse, and they were brushing it down to make sure that it didn't have burrs from its blankets and that it was in good health. And they were making sure it was properly strapped into the carriage and that the carriage was maintained and everything else. It was a service, and it was surrounded by all sorts of things that needed to be done by human beings. When we introduced the automobile, we productized that service. All of a sudden, instead of having to brush down the horse after I, use the horse for a cab ride, I just park it, take the key out, and walk away. And then every 3,000 miles, I need to change the oil or engage in some form of service. But the quantity of service relative to what a horse required meant that we no longer have stable boys in any meaningful fashion, right? Similar phenomenon occurred in the 1920s with the productization of many household services. We used to have washerwomen that would come to our homes and do our laundry if we were of relatively high levels of affluence. We actually had somewhere around 7% of household budgets were spent on things like that. We then introduced washing machines, right? We replaced irons that needed to be heated in the fire with electric irons that heat themselves instantaneously and don't have to be cleaned and maintained in the same way. So we've productized those services, and this is one of the reasons, unfortunately, the Great Depression was so bad, because it was those ancillary services that provided the informal employment that allowed people to get through a rough patch where their husband lost their job, et cetera, right? Or you became widowed due to your husband being killed or injured on the job. The 1930s largely took that away because we'd productized so much of that. AI is really productizing an untold number of services. And we're actually beginning to see the impact of this. The marginal spending on services is starting to fall as more and more stuff is productized. I would point to robotic vacuums as having targeted something that we really couldn't do before. More and more people are using tools like that. Likewise, we think about our investment process. It's largely driven by AI that is being replicated, right? How much should I invest in equities? Well, it depends on your age and a target date fund, right? Ultimately, we will cross the threshold with self-driving vehicles. And this is where it starts to get hairy, right? The single largest job in the United States is truck driver, right? Or driver, to be more precise, right? So taxi drivers, Uber drivers, truck drivers, delivery people, et cetera. As we start talking about productizing that and effectively having that driver embedded in the vehicle, or going even a step further and having purpose-built robotic vehicles that deliver these things, the risk that job loss outpaces our ability to modify our society for this makes it look very sketchy, right? And unfortunately, I think that's where we are. So it is a genuine innovation. It is going to make our lives richer and more multifaceted. We're already seeing people engaged in creative pursuits that they couldn't possibly have done without AI, right? I can't draw a cartoon to save my life, but I can make a film in AI, right? Is it going to be any good? Who knows? But you know what? I get a chance to do it, right? In the same way that we replaced Italian craftsmen who are, hand carving all the molding that shows up in Victorian homes in Newport, Rhode Island. And today I go into Home Depot and I can buy a piece of plastic that has the same bas relief done, right, at a fraction of the cost of my labor, much less a skilled Italian craftsman. So the world is going to become a richer, more interesting place as a byproduct of this. The question is, can we do it with a humanity that allows the people who are displaced to have dignity in our society? And that's where I'm not convinced that we have the right answer yet.
Oh, what a great question to end the podcast on. Guys, this is one of the most intellectual and fascinating, interesting conversations for us We've had some great guests, but Mike, I think you're at the top of the list.
Oh.
Now I know why you're such a celebrity out there with people that want to know how to make money and not lose it. So thank you for participating, and really appreciate your time. We know you're super busy. What's the name of the book going to be? Do you have a name yet?
The book is tentatively titled, and it'll almost certainly be this: The Greatest Story Ever Sold.
Hers and his, Three's Company too. Come and dance on our floor. Take a step that is new.